Financial stability isn't a product you buy from a bank, it's a system you build at home. Most families chase higher interest rates while ignoring the behavioral drift that actually drains their wealth. True security comes from internal discipline, not external banking hacks. Today we are learning the structural truths about family money that banks often overlook, so you can move from being a consumer to a steward of your capital. My name is Selah. Welcome to a space dedicated to practical, wise financial teaching for families. Make sure you subscribe and like this video. To understand how this looks in practice, let's take the Bennetts as an example. The Bennetts spent years rate chasing, moving savings for an extra 0.25% interest while losing thousands to uncoordinated spending. Everything changed when they stopped looking at the bank's rates and started automating a family tax first. In 18 months, their discipline built more wealth than a decade of banking perks ever did. The core principle at play here is systemic sovereignty over product reliance. We must understand that a bank's primary goal is to use your deposits to fund their own growth. While this is a legitimate business model, it is not a strategy for your family's growth. Notice the pattern. High-interest debt is often marketed alongside rewards programs, creating a cycle where the family feels they are winning small points while actually losing ground on their total interest spread. This is where drift begins. When a family relies on the bank's tools, like credit limits and minimum payments, to define their affordability, they hand over their sovereignty to an algorithm that doesn't care about their retirement or their children's education. Pause and consider what that means. If your financial plan relies on the features of a credit card or a specific bank account, you're building on someone else's foundation. True stability is built on a foundation of stewardship, where you dictate the flow of every dollar based on a predetermined family mission statement. It is the difference between being a passenger in your financial life and being the architect of it. Stewardship requires us to see money not as a tool for immediate gratification, but as a seed for future stability and generosity. When we look at the data regarding American household debt, a clear signal emerges. The convenience of modern banking often correlates with a decrease in actual savings rates. For example, the rise of buy now, pay later services has made it easier than ever to fragment a family's income before it even arrives. Statistics show that households that use these automated microloan features are significantly more likely to carry a balance and pay late fees than those who stick to a traditional cash flow model. Furthermore, while banks advertise cashback on spending, the data suggests that consumers typically spend 12% to 18% more when using plastic or digital wallets compared to disciplined, tracked spending. This is a signal that the tools provided by financial institutions are often optimized for spending, not for saving. We also see a trend where families focus on optimizing small details, like credit card points, while ignoring the massive impact of interest drag from car loans or carrying a revolving balance. The truth is that no amount of 2% cashback can outrun a 20% interest rate or a lack of an emergency fund. We must interpret these signals as a call to return to the basics, tracking, budgeting, and maintaining a healthy margin. To reclaim your family's financial sovereignty, follow these structured steps to build an internal system that outperforms any external banking hack. This process is about building a wall of protection around your household income. Number 1, the interest spread audit. List every debt and every savings account. Calculate the net interest spread. If you are earning 4% on savings but paying 19% on a credit card, you are mathematically losing ground every day. Prioritize eliminating high-interest drag before you focus on investment returns. Number 2, establish your internal ceiling. Do not let a bank's pre-approval letter tell you how much house or car you can afford. Establish your own ceiling based on a conservative 25% of your take-home pay for housing. This creates the margin necessary for future growth and allows you to breathe when life becomes expensive. Number 3, the 24-hour friction rule. Banks make spending frictionless with one-click buying. Reintroduce friction by requiring a 24-hour waiting period for any non-essential purchase over $50. This breaks the impulse cycle and centers your spending on logic rather than emotion. Number 4, automate the family first tax. Set up your direct deposit to split your paycheck before it reaches your main checking account. Send a fixed percentage directly to a separate institution, one that isn't connected to a debit card in your wallet, to serve as your long-term stability fund. Number 5, the subscription cull. Banks love recurring payments because they are easily forgotten. Once a month, print your statement and manually highlight every recurring charge. If you haven't used the service in 30 days, cancel it immediately. This recovers the leaking capital that belongs to your future. Number 6, cash flow mapping. Instead of just looking at your balance, map out your fixed expenses against your income dates. Knowing exactly when money leaves prevents the invisible drain that happens when multiple bills hit simultaneously without a plan. Number 7, quarterly system review. Every 90 days, sit down as a family and review your burn rate. Is your spending aligning with your values? If not, adjust the system, not the goals. This is how you ensure that your behavior remains the primary driver of your wealth. We must dive deeper into the concept of margin as a family's primary defensive line. In the modern financial world, we are encouraged to be efficient with our money, meaning every dollar is assigned to a bill, a debt, or a purchase. However, efficiency is the enemy of stability. A stable household requires slack in the system. Think of your finances like a bridge. If a bridge is built to hold exactly 10 tons and a 10-ton truck drives over it, there is no room for error. If the wind blows or the truck hits a bump, the bridge fails. Wise financial teaching suggests we build a 20-ton bridge for a 10-ton life. That extra 10 tons is your margin. It is the cash sitting in a boring savings account that earns less than the stock market but provides 100% of the peace of mind during a job loss or medical emergency. When banks offer you a line of credit, they are offering you artificial margin. It feels like safety, but it is actually a trap that increases your future risk. True margin is owned, not borrowed. It is the result of intentionally choosing a smaller house, an older car, or a simpler lifestyle so that the weight on your financial bridge remains light. This discipline allows you to be the lender in your own life, rather than the borrower. The reason the banking industry thrives is that they understand human psychology better than most families do. They know that we are wired for immediate rewards and that we tend to overestimate our willpower. This is why points and rewards are so effective. They provide a small hit of dopamine that blinds us to the larger loss of interest or overspending. To counter this, your household system must be environmentally designed. If you want to save more, make it hard to spend. If you want to invest for the long term, make the account difficult to access. By moving your Family First tax to an account without a mobile app or a debit card, you are using choice architecture to protect your future self from your current impulses. We must also acknowledge the decision fatigue that comes with modern money management. If you have to decide to save every single month, eventually, you will have a bad month where your willpower fails. But if the system is automated, the decision is made once and executed forever. This is how the Bennetts in our story finally found success. They moved from a willpower model to a system model. It is vital to maintain a realistic perspective. There are no secrets or shortcuts to wealth that involve bypassing the hard work of discipline and patience. Financial markets are inherently volatile, and even the most stable banking institutions are subject to economic cycles. Therefore, your safety is found in your liquidity and your lack of debt, not in the promises of a specific investment product. Avoid the urgency messaging that suggests you must jump into a new trend or lose out. Wealth building is a cumulative effect of thousands of ordinary, boring decisions. It is the result of choosing to live below your means so that you can live with more meaning later. Be wary of any product that promises guaranteed returns or instant growth, as these often carry hidden risks that aren't apparent during bull markets. True financial wisdom involves being prepared for the downturns, not just participating in the upswings. It is about being a steward who is faithful in the little things so that eventually you can be trusted with much. The goal of your financial journey is not to become a professional at navigating banking products, but to become a master of your own household's resources. The goal is not perfection in every transaction. It is preparedness for every season of life. Stability is built through repeated ordinary decisions, made with a long-term vision in mind. Banks provide the tools, but you provide the direction. Begin by building your own internal structure, stay consistent with your discipline, and let the power of time and patience do their work.